From my personal experience in understanding the minimum variance portfolio in the efficient frontier, it is nearly imperative to see one constructed in real time. So that's what we're going to do for you. We're going to use a portfolio of Apple and Johnson & Johnson, equally weighted 50% each to a combined 100% of the portfolio. So what we're going to do is we're going to jump into Yahoo Finance. First, we're going to dive into the historical data of Apple. We're going to adjust the pricing history to a 5-year timeline, and that's just for accuracy. The longer you go back, the more accurate your statistical data will be. So we're going to download that from the Yahoo Finance API, and we're going to get the adjusted close. You don't want to get the close, you want to get the adjusted close, and I'll explain why in just a second. So we're going to copy that, paste it into our spreadsheet. And these are the daily returns. So every day the market closes, that return or that stock price, the closing stock price, is recorded. Copy and pasted the dates there. We're going to use the same dates for each of these. Now you'll notice in Johnson & Johnson, I'm going to point out that there's a dividend date which conveniently popped up there. And I did a little bit of math just to show you. So if you look at the close, right under the dividend of 1.01, you'll see in a second. Right there, 1.01. If you look down to the right, you'll see 1.6298, and then you'll see adjusted close of 1.61. Let me move this out of the way. 1.6197. Now that's the close and the adjusted close. The difference between those two is 1.01, which you'll notice is the exact amount of the dividend. So that's why the adjusted close is so important, because it accounts for the dividends as well. Now we're going to do our first computation, which is computing our daily returns. And then what we're going to do is we're going to turn that into a percentage, because that's the best way to analyze daily returns on stock. Next, we're going to label a section called statistics. And this is where we're going to keep all of our statistical analysis of our two equities. This is the most important part, because the minimum variance portfolio and the efficient frontier created by Harry Markowitz is all based on statistical analysis and historical returns of stock data. So we're going to have things like average return for daily prices, and then we're going to have variance, standard deviation, and correlation. And just keep in mind that all these returns are in daily format, so they're daily returns and not monthly or yearly returns. So we have the average return, variance, and standard deviation. Next, we're going to have the correlation of the two stocks, and this is important because eventually we're going to find statistical information on the portfolio of those two stocks. So I'm just using the average function here. And you'll notice that I did make a mistake in computing the daily percent returns. At the very end, you'll see there's 100%. You want that out of there. You don't want 100% because that's incorrect. It's just a clerical error. Just make sure you don't do that. So I have the correct ones. I'm just checking it out there. Now we'll move on to the variance. You'll want to use a function called VARP. That'll compute the variance of a selected array. And I'll just copy and paste that over to the next one there. When computing the standard deviation, it's typical that you'll take the square root of the variance, but in Excel, we like to take the variance to the power of 0.5, and that gives you the same effect. Now we're going to compute the correlation between the two assets using a function correl, C-O-R-R-E-L, in Excel. And we're going to take the pricing data, the daily returns, and see how correlated they are to each other. This is an incredibly important step of the process, because the stock correlation describes the relationship that exists between two stocks and their respective price movements. So the correlation is based on a scale from 1 to -1, +1 being perfectly correlated, -1 being perfectly negatively correlated, and then 0 being completely uncorrelated and moving completely independent of each other. Alright, so now I'm creating a portfolio section where we're going to keep the information for the portfolio itself instead of the individual stocks like we did above. Right now we're going to put in our weights. We're going to do 50-50 each, so equal weighting of Apple and Johnson & Johnson. And then after that, we're going to calculate the return on the portfolio given the weight. So a weighted return. We're going to take 50% multiplied by the average return of Apple over that course of time, and then we're going to do the same for Johnson & Johnson. And we're going to put that in a single cell because this is going to be our portfolio daily return given those two assets. And now we're going to do the standard deviation. This is a very complicated and tedious task because you want to make sure you get everything right. So we're going to start off by taking Apple's weight in the portfolio, multiplying it by its standard deviation, and raising it to the power of 2. Now we're going to do the same for Johnson & Johnson. Take the weight, multiply by standard deviation, and take it to the power of 2. Now we're going to add 2 to this equation for the number of equities in the portfolio, and then we're going to take Apple's weight again, multiply it by Johnson & Johnson's weight, and then we're going to take Apple's standard deviation, multiply it by Johnson & Johnson's standard deviation, and then multiply that by the correlation coefficient, and bring all that to the power of 0.5. And that will give you the standard deviation of the portfolio. We're going to change that to percentages. Now the next part I'm going to go over pretty quickly because we've already done most of the computations. What we're doing essentially is creating 10 hypothetical portfolio situations where we're going to see what the return of the portfolio is given each individual weight. At the top there you'll see Apple has 0% weight in this portfolio while Johnson & Johnson has 100. Next one, Apple has 10% weight while Johnson & Johnson has 90. So based on these weights we're going to compute the daily returns, and then we're going to do the standard deviation of each weighted portfolio. So basically the same thing, but this is for the standard deviation of that any given portfolio. Now that we have all of our data and all of our hypothetical portfolios, we're going to throw this data into a chart so we can view the efficient frontier and the minimum variance portfolio, because that is the best way to grasp an understanding of the importance of these concepts. So the x-axis is going to be the standard deviation, and y-axis is going to be the return on portfolio. That's an important note. I'm going to make this a little more aesthetically pleasing. The colors are a little bit boring, so I'm going to add some flair. Now what I'm doing is I'm highlighting the minimum variance portfolio, and I'll go into greater detail in a little bit, but that boomerang illustration you see there is the minimum variance portfolio, okay? And the point that's on the graph that's illustrated is the highlighted portfolio of 20% Apple and 8% Johnson & Johnson, where you see a standard deviation of 1.209 and a return on the portfolio of 0.069. And what this means is that this is the portfolio that has the least amount of risk, the least amount of standard deviation. Standard deviation and risk are synonymous terms. So I graphed what the expected return on that portfolio is and the standard deviation there. So right now I'm labeling the efficient frontier, which is where that arrow is pointing up and to the right. Any of those points on that boomerang shaped line is a portfolio, and any of those portfolios above the minimum variance portfolio, where that arrow is pointing, is going to be considered an efficient portfolio. Now where my cursor is below that line is an inefficient portfolio, because the portfolio where my cursor is has the same amount of standard deviation as this portfolio right here, but this portfolio has a higher expected return. Okay, so that is why it is considered inefficient, because you are leaving money on the table essentially. We are going to wrap things up, but before I end this video, I want to establish the key takeaway from the minimum variance portfolio and the efficient frontier. and their importance to portfolio management. We're going to do this by taking a look at our portfolio matrix here. Our first portfolio, Apple has a weight of 0, Johnson & Johnson has a weight of 100%. The standard deviation of this portfolio is 1.249, and as we go down the matrix, the weight in Johnson & Johnson decreases as the weight in Apple increases. So when we get to our minimum variance portfolio, which is the portfolio highlighted in yellow, we have a Apple weight of 20% and a Johnson & Johnson weight of 80%. Now the standard deviation of that portfolio is 1.209, which is actually less than the standard deviation of portfolio 1 with just Johnson & Johnson. Now this is interesting because Apple has a significantly higher standard deviation than Johnson & Johnson. So intuitively, you would think that adding Apple to the portfolio would increase the portfolio standard deviation, but it doesn't. Adding Apple actually reduces the standard deviation while also increasing the expected return. That is the magic behind the minimum variance portfolio and the efficient frontier. Adding that additional risky stock to the portfolio can increase the expected returns while at the same time decreasing the standard deviation of the entire portfolio. I hope this video helped you. Thank you for tuning in, and I am glad to see that you're taking the right steps to better your investing and portfolio management knowledge. Keep it up, and we will continue putting out quality content. Thank you, and I'll see you next time.